Thank you for joining us. You're listening to Fixed Income Academy's monthly conference call recorded on Thursday, September 12th, 2013. On the call is Fixed Income Academy CEO Susan Munson, in addition to Chief Economist David Horner. Mr. Horner is an independent economist and a financial strategist and directs a small private hedge fund. He also provides macroeconomic advice and trading strategies to high net worth individuals and institutional clients. He has more than 30 years of experience on Wall Street and in government. Let's join the conversation.
So right now, every single month, they are buying $85 billion worth of bonds out of the market and infusing that cash. And David's official call is that they are going to announce at the Fed meeting next week that they're going to reduce between 10 and $20 billion per month. I think that's what you said, right?
Yeah, 15 plus or minus 5.
Okay, so it works. Right. I got the math right. Okay, we're on the right track. So, they're going to announce it and then to begin the reductions in October. So that's his call, but of course there's quite a bit of debate about that and controversy. But what we've been hearing a lot is that they are going to be depending on the economic indicators. And the buzzword that's been thrown about lately, the last couple of months, is that we keep hearing that the Fed is data dependent. It seems to me that being data dependent has been what the Fed has said all along. Like, I think the Fed has always been data dependent. So, and I think this is just a recent term that the media has coined. So my first question is there really anything new or different now than it has been in the past, related to this reliance on data that the Fed has to determine monetary policy?
Thanks, Susan. Let me just backtrack just a little bit to provide some context for answering this question. As I'm sure most of you know, the Fed has what's called a dual mandate with regard to monetary policy. On the one hand, it's supposed to monitor inflation and keep inflation at a very low level. Their current target for inflation is 2%, although if it went up to 2.5%, it might not change policy, although clearly it would be a signal to the markets that they would become tougher. Conversely, if as Bernanke has been worried about for quite some time, if inflation began to fall and he thought it might even go negative, and certainly anything below 1% it has him worried, then they might become more accommodative. But the other part of the dual mandate is that, unlike many nations, the U.S. has a mandate. The Fed has a mandate to maximize employment consistent with the inflation objective. And this differs. The ECB, for example, is based on what before the euro was German policy. They too have a dual mandate. Their mandate is like the Fed's. To keep inflation, that is, prices steady, a very low rate of inflation, if any. But their other mandate to support this is to support the price of their currency. They don't have an employment mandate. So, for example, currently the euro is probably pretty much where they want it. They don't necessarily want it to strengthen, but they want it to weaken either. So the Fed, for the last 2 years, the last 5 really, but as we normalized a little bit coming out of the crisis, they nevertheless introduced a quantitative easing of buying huge amounts of bonds, 85 billion of treasuries and mortgage type bonds, in order to maintain a price level that increases. Their big concern is that it decreases, and it hasn't done that, but certainly it's been on the low side of their 2% target. Now, the second thing that I think is important to answer this question, and this really gets more to what they base their decisions on, is the data. And they've always based it on the data, but it's become more prominent recently because the Fed, as it has said in many of its communiques, the reason they're so accommodative is because they're trying to boost employment, and they will keep trying to do that until they're concerned about inflation. So the question arises that Susan just asked is, well, what data are they looking at? Well, obviously they're looking at employment rates. They've even said that they want the employment rate below 7%, and ultimately, before they raise rates, they want it below 6.5%. But The important thing to remember here, and I think that sometimes gets lost, is that my mentor, one of my mentors, Milton Friedman, always said, and one of the reasons he didn't like the Fed changing policy much is that monetary policy works with what he called a long and variable lag. So the data that they look at, really they concentrate most on is forward-looking data. This, what do they think is going to happen to the economy? Because we know the economy's been sluggish. We've been in what I refer to as a new normal. But what they don't know is, are we going to continue with that sluggish growth, and is it going to go down, or is it going to be strong enough that it continues to bring down the unemployment level? And so they really concentrate on what they think is going to happen in the future. And I can go into.
Okay, yeah, we'll talk about that. Okay, so
Okay.
let me just make sure I summarize and make sure I'm understanding clearly. So in very, very simplistic terms, you could say there's a dual mandate by the Fed, and they're going to target 2% inflation and 7% unemployment. So they're trying to reach those numbers. But the 7% unemployment number, that's kind of a lagging indicator. That's something that's already happened, not something that's happening in the future. So you're saying that what the Fed's doing, and instead of just looking at these two hard numbers, they're looking at leading indicators to determine what the future holds for us.
Exactly, because we're currently at 7.3% unemployment, but we're headed. Some people think we are, and some we're not. Towards 6, and then hopefully, I'm sorry, towards 7, and then hopefully towards 6.5. But the timing of that's very uncertain. And what the Fed has to do is try to anticipate in advance whether the growth will be sufficient in the second half of the year and even in the first half of next year to achieve that objective as they begin to lower their quantitative easing. Because for monetary policy to work as they think, they have to act now to anticipate what conditions are going to be 9 months to 18 months in the future.
Okay, so but my question still is there anything really different then that we're all of a sudden using this term that they're now data dependent?
There's really nothing different in what the Fed is doing in terms of what it's looking at. But what is different is that we're in what they call extraordinary policies. These are policies you would only use in a crisis. We're still recovering, in other words, from the housing and the financial and the economic crisis that occurred 5 years ago. You've heard me many times use the term new normal. We're having sluggish spending, sluggish growth, and we're, in my opinion, somewhat fortunate that the unemployment rate has come down as much as it has. And in fact, one of the reasons it's come down is because people are leaving the labor force, and that again that negatively impacts spending and growth. And partly they're leaving because the baby boomers are aging out, and partly they're leaving because they can't find jobs, and that's not good.
Okay. Okay. So that's a good, really very good basis for the following questions. As of right now, does anyone else have any questions that I didn't ask that you'd like to ask David about what he talked about so far?
No, I don't have anything.
Okay. Okay. Thanks. All right. Well, let me know if we do. We'll continue on. Okay. So, let me see.
Yeah.
That's the new data. Okay, I do have a question about your weekly reports. Some of you might read our weekly economic reports. In your weekly reports, you highlight some of the more critical economic releases. Are those releases you highlight ones you think are going to drive the markets or influence the Fed's monetary decisions?
Well, both. Mostly it's that will drive the markets.
Okay.
But I mean, the Fed looks at everything. They have a broad staff that looks at everything. But the key ones will be those things that kind of give them a glimpse of the future. So I mean, there, as I'm sure most of you who follow the markets know, there are many indicators I don't uh, talk about, and the reason for that is quite simple. I like to keep my summary short. I have another job, which is my fund, and it's really a guideline to what I think is critical to the markets. But today we can discuss maybe a few of those things that
Okay.
I think are critical to the Fed.
To the Fed. Okay, perfect. Okay, that was just curious for me. So we talked about employment already a little bit, and it's something obviously the Fed keeps a close eye on. Which components of the employment report do you think they watch the most?
Well, the unemployment rate is something that they can always convey to the market. Hey, we want this to go down. But what they're looking at in terms of is the economy going to grow mostly is non-employment measures. And the reason for this is because, as you mentioned correctly, the employment data for the most part is either what's called coincident or lagging data. It may tell you if we're employing a lot more people and hourly earnings are going up, it tells you that we've got an underlying positive base for growth, but it doesn't really tell you much about future growth. Some indicators are more concurrent than others. For example, today's jobless claims, first time in a long, long time, it went under 300,000.
Mm-hmm.
That may be an anomaly, but I like to look at 3 or 4 weeks. But that would be more important to them in terms of predicting the future than the unemployment rate.
Oh, okay. Okay, so those are the different types of reports. Now, I did hear, just as a very quick side note, already it said on the financial news not to pay any attention to that report today because 2 states redid the way they count the claims.
Yeah,
and so so the Fed's already saying disregard that number.
Absolutely. There are usually anomalies in any weekly report. This is something actually that's going to be true going forward. What I like to do is look at the average over 1 to 3 months. But again, as you might suspect, that's concurrent. That doesn't really necessarily predict the future. And there's always caveats like the one you mentioned.
Okay. So they are going to be looking at more concurrent and leading versus lagging indicators. So there's 3 different categories of indicators, if you will. But before I ask that question, some of us are more concerned with the notion of underemployment than others. My most important question is this something the Fed is concerned about? And before you answer that, can you define underemployment?
I mean, underemployment basically is people who report in these surveys that they would like to work more hours, and 2, people that report that they're not looking for work, but they would be if they thought there was a job available. The latter group is called disguised unemployment. These people are unemployed, but they're actually counted as out of the labor force. The ones that are working less hours, this has become much, much more of a problem in recent years for a couple of reasons. One, by getting people off the book and contracting them, they can vary the hours. And 2, with the passage of Obamacare, many corporations that hire a number of people, food chains are very much in the news about this. They don't want to pay the health benefits, and so the act basically says if people work under a certain number of hours, if they're part-time employees, that they don't have to pay that. So, as you probably know, profits for corporations are as high as a percentage of GDP as since World War II. So, as a result of this, the U6 has gone up dramatically because there's a lot of people that are underemployed now. And yes, the Fed is very concerned about this, although to keep it simple in their communications, yes, they generally refer to the unemployment rate.
Mm-hmm.
But what they're watching is the increase in payrolls, the hours worked, et cetera. Now, one of the things that you and I talked about this morning, Susan, is if somebody's working 40 hours a week or the full time, but they're earning less pay, but you gave up a job for good money and had to take a job for less money, that's not unemployment. That's a change in salary. But as one of our people questioned, that does impact spending because they have less money. But that is not unemployment. That's basically taking a job cut, which affects your income.
How do we monitor that? Or how does the Fed monitor that?
Oh, the Fed has very good data on that.
Oh, they do?
Oh, sure. Yeah. And again, remember, they want to know what growth is going to be and how that growth might affect employment in the future. Ultimately, remember, their goal is to keep down unemployment, But the data they look at are the kinds of data that will tell you whether or not you're going to be able to lessen the unemployment. Right now, there's very, very little that they can do about the problem of underemployment with regard to the people who work less than 40-hour week. And the reason for that is because that's based on policies and laws that they have no control over. So that's going to continue to be a big problem.
But couldn't that be how we're going to be forever in the future?
Yeah, it's going to be absolutely.
Okay, so could it be that it used to be we wanted to target a 6% unemployment rate, but now because of the way we're changing our work habits and working in the future, it's going to be 10?
Nope. The reason for that? No, because they have no control over that. They can stimulate. They can stimulate the economy, and they can make us grow faster, and therefore they can create employment. Mm-hmm. But they cannot really affect the mix of how people are employed, the hours they work, whether they get health benefits, things like that. They really have no control over that. And so they will stick with the unemployment measure. But again, this is not to say that they don't think it's a big problem. They do. Okay. And that's one of the reasons why Bernanke is constantly in his testimony. He's done it very nicely. I wish sometimes he'd slap his shoe on the deck like Khrushchev did and say, look, you guys have to, Congress has to affect the regulations and the laws and the policies that give employers an incentive to basically keep people on full time. So, but they can't do anything about it other than jawbone like we can or your.
Yeah. All right. Because, this is my little anecdotal story, is I think more and more people are being contractors, consultants, and companies are hiring people off of payrolls. And I think that's just going to continue.
You're right. They know it, and they can't do anything about it.
All right. We know it. We can't. Yes.
Then I have a question. Doesn't that mean that the unemployment rate isn't correct then? If those who stop looking for jobs, how do they account for them?
They're called discouraged workers. That hasn't changed. I mean, no, I think the employment measures are quite good. There's a question of whether they're accurate because it's a survey. I mean, they're only as good as the data, and Congress has allocated less data money to the Bureau of Labor Statistics, which collects all of the unemployment and employment statistics. So there's a question of how accurate the data is. But no, I think the definitions are quite good. I think your question arrives in the fact that most people are not economists, so they only hear about what they read on the front page, which is the unemployment rate. And if you're asking the question, is that really the right thing to focus on? I agree. The answer is no. But we have the other measures. We know what they are. We've got a good handle on them. And underemployment is a tremendous problem. But they've been measuring discouraged workers for ever since the 1930s. I mean, the data definitions have not. Well, there have been changes in the data definition, but not with respect to underemployment. The problem has gotten a lot worse. There's no question about that. But they always have had a good measure of it.
So we can say that it is something that's not being emphasized as it should be.
Oh no, it's being emphasized. If you're saying the media.
Yeah.
Well, look,
we can't control the media.
I don't look. I have car problems every once in a while, and I take but I don't look over the shoulder of the guy that's fixing the car. I mean, I wouldn't expect the public to have a detailed knowledge of the nuances and the arcane measures of employment. But the Fed does have them. They know them. The Bureau of Labor Statistics. Okay. So it is well known. It's just that we don't talk in general conversation.
Can we go to the BLS and see what the underemployment rate is?
Absolutely.
Do you know what it is? I've heard 17%.
Well,
what is it?
The U measure that measures that is I didn't look it up last week,
okay.
But it's been over 16%. It may be a little under that. I don't know the exact figure right now, but yeah, I could go to the labor. You could go to the Bureau of Labor site if you have an interest in that. You can do that. Absolutely.
All right.
That's all there.
All right. Sheila, did that answer your question or?
Yeah, but where do I go for that information?
I'll send you the link.
BLS.com. I'm sorry, .gov.
BLS.gov. And I think that I even have the page bookmarked somewhere with the actual page that has all the statistics on it. But BLS.gov has all this information, and it's very good.
It's a good site. I mean, as soon as you go there, it's very good about letting you know, in their table what's available, what it is, and they've got more statistics than you're going to want to look at.
Yeah, so there's all of it there.
All right. Thank you.
Okay, you're welcome. Okay, my next question is about the ISM numbers, because you recently mentioned that the components of new orders were rose sharply recently, but investment remains weak. So I've heard you emphasize again and again, and other economists emphasize the importance of investment versus consumption. And I want to know, is the ISM one of the more important indicators to watch to gauge investment, or are there others that we should be watching?
Well, if I can say, let's not talk about investment here, we can have another call on that, because it's very, very different from what the Fed's going to do next week, which is important. But having said that,
but wouldn't they look at investment for the future?
Well, they do.
Okay.
But remember, they want to know what's happening in the future. Investment contributes to growth, but what drives investment is consumption. Okay. How much we consume, and our change in our international trade. For example, we're through fracking, and which is very controversial, but nevertheless, we are working toward becoming energy independent. There's tremendous amounts of investment right now in the energy area. Less investment in the housing area, because we have so many leftover resources that are unused, are only now being able to work up. Although housing has been increased in housing price activity, it's nowhere near the level it was before the crisis. But on the other hand, autos and other durable, we're right back to where we were before. So you find, for example, a lot of investment in autos. They're adding shifts, and they're adding plants. But what drives that is consumption. So the reason that I featured new orders is because when the Fed sees that orders are rising on the ISM, that means that their demand is rising. Then in the future, we'll get investment. But they were very clear to say that we haven't reached the level of demands right now where they're very optimistic about investment in the future. And that's a very important question.
Okay.
But it doesn't have much to do with the what are they looking at that's going to drive demand, because it's the increase in demand that will drive growth.
Okay. So, but you mentioned consumption, and what was the other thing you mentioned? You said that investment is driven by consumption and
international trade.
In other words, trade. Okay, so international consumption.
Absolutely.
Okay.
So, for example, the fact that Europe is growing very, very slowly. I don't want to overemphasize this, but definitely there's been a shift from recession to, and they're one of our biggest trading partners. So that's a positive. Japan 6 months ago began to pursue a much, much more aggressive monetary policy, much like the quantitative easing that we're doing. So there too, we've seen growth pick up in Japan. Recently, revised second quarter growth in Japan came out higher, as did our revised second quarter growth from the first quarter. Those are all positive signs. Those are the kinds of things the Fed is looking at to know what's going to happen, not now, but what's going to happen going forward, because they have to anticipate as they affect their policy.
Okay, and so they actively gauge all the global economies and what's happening, because that very much ties into.
Oh, you betcha.
Okay, yes. So I guess I could say what things do the Fed watch, and we could say all of them, but
but what we're trying to do here, and you're correct, we're trying to see which are the most important ones. And that's why I make this case over and over that the most important ones of the Fed are those that tell them about future growth, because they have to affect policies now that respond not to current growth, but to what they think is going to happen in the future. And it's a guesstimate.
Okay, got it. Another question came in about retail sales. So is how much of retail sales is adjusted for cost inflation?
None. And that's one of the things. I haven't stressed this recently, but Nicole, I think you asked this question. Generally speaking, the retail sales is one of the few reports that we get out of government that's nominal and not real, meaning it's not adjusted for inflation. So, for example, in times of high inflation, you'll find retail sales generally run pretty high, but the actual impact on economic activity might not be as high. Now, recently, because of the rather large fluctuations in gasoline prices, a lot of economists have chosen, you see this from some of the Wall Street economists, they'll take out gasoline sales because a lot of the increase or decrease is based on price changes. Mm-hmm. However, it's very important. I mean, they're not taking it out because it's not important. As prices go up, it doesn't really matter if people are buying more gas or whether it's prices. That can negatively impact on spending because people have less income left to spend at Walmart or Tiffany's or wherever they're spending. So it definitely, retail sales is a concurrent number, but the changes that we see in gas prices are very important to the Fed because that can affect future real sales, and it's real, not nominal sales that basically cause your economic activity to go up or down. In other words, how much people can buy. If they can buy more, after accounting for inflation, then growth will be higher. Okay. So no, unfortunately, they do not correct for inflation.
Okay. Okay, and then want to ask a little bit about the shadow inventory of homes. I'm not sure it's something that you are completely tracking, but we've heard a lot over the last several months, not so much recently, about this inventory that's being held back by banks. And what effect would this have on the housing recovery that we are seeing once those inventories are released? Do you have a comment on that, or?
Well, again, I'm not an expert on housing, but number one, certainly in terms of affecting the Fed and their decision, they're very aware of this, obviously, because they're monitoring the banking system. There's no question but as these get released, depending on the size of them, and this will vary by community, that it could affect the price increases in housing. I mean, we've seen a fairly nice bump in housing prices on average and in most communities over the last year and a half. But as more supply comes on the market, then clearly that can affect prices. However, remember, housing in terms of the sales of housing, if you're a realtor and you're looking at how many of existing houses are buying and selling, that is a shift in assets, not a shift in activity. The realtors are engaging in activity, and that goes in the GNP. But housing activity, which is what affects growth directly, I mean, it is growth. You look at housing starts, they're still way, way below what they were before. But as I understand it, and again, I'm not an expert on housing, there's a lot of pent up demand for housing by people, for example, who are living with relatives, by people who are renting but don't want to be renting, and just by the growth in family formation of the younger population, because there is the echo boom. They're pretty much into the market already. So you really have to have a fairly solid knowledge of demographics to kind of know what the demand is relative to the supply. But the shadow inventories per se should affect price by holding it down as they get released, but probably won't affect activity that much. I mean, to the extent that realtors are more busy, that's good. That's a good thing. But that's a very small component of the overall housing industry.
Okay. Cool. Well, does anybody else have any other questions specifically, or before I summarize up? Try to make us a bullet point list. Okay. Well, in case anybody's thinking, what I got out of this is that there's pretty much 3 different types of indicators. We have our lagging, our concurrent, and our leading indicators. And when we're wondering what the Fed is mostly looking at when they're trying to determine what their future monetary policy moves are going to be, they're mostly looking at the leading indicators. So to determine what's going to happen in the future. So the indicators that come across our desk and we're paying attention to, the ones that are going to be telling of the future economic growth, are the ones that we should be most interested in if we want to try to figure out what the Fed's going to do. Is that a good summary?
Well, that is a good summary. And let me just conclude my remarks with my forecast, because for you next week, if you're looking at the markets and wondering where rates are going to go, where the market's going to go, it's very dependent on 2 things. One, 2 o'clock the release of the Fed communique, which will tell you whether the forecast is correct or not.
Okay.
And number two, the press conference at 2:30, where Bernanke will explain the nuances of what the communique means.
Okay.
Now, my expectation is 15 billion, a reduction to 70 from 85. My expectation is that they will not announce any further declines. You may remember, not last meeting, but the meeting before, they indicated they'd like to be done with this by the middle of next year, and they probably would. But because of the uncertainties of fiscal policy, primarily, but also to some extent what's happening in the Middle East, not just in Syria, but in Egypt as well, they probably want to reserve any talk about further reductions. And so I think it'll be a one-time, what I call toe in the water of reduction to see how it affects the markets. I think I'm right at the consensus. So if that's exactly what happens, I'm guessing it won't have too much impact on the market or rates. However, if I'm wrong, and I often am, if, for example, they're more aggressive, they reduce it by 20 billion, which would be the most I think they'd reduce it, or they announce further reductions in advance, which, as I say, I don't think they'll do, that will probably be negative for the equity and asset markets, positive for those rates will go up on that.
Okay.
Conversely, if they do nothing, we'll probably have at least a short-term knee-jerk rally in the stock market. And I don't know. I'd be hard-pressed to say what rates will do. On the one hand, it means more accommodative. Rates could go down. On the other hand, people having been surprised and feeling that the Fed might lose a little credibility on that. I mean, I think that there's a lot of people, the market, the investors, as opposed to the household spenders, probably want the Fed to begin that process, probably feel that most of them, I think, feel the Fed has overextended the quantitative easing purposes. So that would be pretty much a wild card for rates, in my opinion.
Okay. That's a good summary. And the last thing I want to leave with is that for all of us who've been through bond school and learned from Dr. Ray Stone how monetary policy works, he emphasized that the large-scale asset purchase program is really what is going on when we are calling out quantitative easing, because that term kind of stuck a few years ago, and it's never, we never moved away from that. But if you think back to how Ray described the large-scale asset purchase program, that's how the Fed thinks of it. That's how they think of their program of buying assets and selling assets, and they kind of think of it as an adjustment that to be made over time, not of separate programs. So that always helps me to think of things in those terms. So I just wanted to bring that up. I guess we've lost that fight of trying to, because even Bernanke wouldn't even call it quantitative easing in the early days. I'm not sure if he finally started to do it as well, but even he used to not even say quantitative easing. But anyways, that's a side point, but it helps me think through how it works. Okay, so we have one question is, David, what is your forecast on to the S&P 500 movement following the policy statement? Notice markets reacting all over the place. Any idea when we get back to normality and historical movement patterns?
Well, I'm not sure what normality is. I mean, the market has understandably more than doubled and is much, much higher than obviously the March 09 low. But that's exactly what you'd expect in a program like this, where the economy is recovering and the Fed's balance sheet has gone from 800 billion before the crisis to over 3.5 billion now.
Trillion.
Or trillion, yes, trillion, billion, trillion.
Yeah,
a lot of money.
A couple of zeros.
And so, I make a forecast in my weekly comment on the S&P, but I often have to change it. I always like to change it before it happens, rather than the horses out of the door. So this is my way of kind of acknowledging that I don't know for sure what's going to happen to the S&P, although I always have a guess because that's what I trade on. I think that the expectation, since I'm at the consensus in my forecast, is probably not going to have too much impact on the market. I think the rally in the market this week, for example, has been caused by two things. One, the fact that it looks like whether you agree with Obama policy or not, it does look like there may be some compromise that maintains the status quo. So that removed kind of a fear that we get ourselves enmeshed in another war, at least for the time being. The other thing that I think is affecting the market is I think investors are beginning to realize now that the expectation for tapering, which again is a word that Bernanke has not used, is in the market. We still have a very accommodative Fed, even if they do taper. We still have profits that are not going down, although I think we're reaching the maximum on margins at this point. And we have growth overseas. So I don't expect a big negative to the reaction to if they announce the quantitative easing. If they don't, I think that you probably get a temporary bulge in the market, but I do think there'll be a lot of investors who think that's the wrong policy. And so I'm not sure if there'll be much follow through. So I think the upside's still limited probably to 1700, 1750, regardless of what the Fed does. But at the same time, I think we're fairly well supported by the prospect of continuing QE, even if it's reduced, probably in the 1550 to 1600 level. So I'm not expecting a whole lot of movement. But I'm not sure what you mean by a normal market. Would you mean more volatility or less volatility?
Tim, do you want to follow up or? Yes, more or less, but yes, I'll hear.
Okay. I think I don't see what's on the horizon at this point, either politically or monetarily or militarily overseas, to really increase volatility a whole lot. So I think we're in somewhat of a normal market right now. But what would you look for to make it increase in volatility? Well, Middle East is clearly, any cutting off, not necessarily problems in the Middle East. We've always had those, and I don't think they're going away soon. But if that impacted energy in a supply side way, then that probably would cause an increase of volatility and would be negative for the market.
Yeah. Okay.
That would be one risk. Right now, I don't see. I mean, obviously, something can come out of the blue, a tsunami, North Korea suddenly getting more militaristic. There could be things, but nothing that I could forecast.
Got it. Thank you. All right. Very good. Does anybody else have any questions before we let you all go back to your busy days? Yes, sir.
Yeah. One other thing, Tim. I will be raising my rate. We're above the my range on the S&P because we're above the top end of the range. I was overly cautious moving into this tapering, but I think both the Syrian development and the fact that it's in the market is bringing some investors in. So I'll probably raise the top of my range to maybe 1725, but I may widen it as well because obviously it's very important what the Fed does next week and could cause some temporary volatility.
Tim has a follow-up answer question about the S&P, but maybe what we'll do, if you don't mind, we'll just go ahead and answer that back for you privately. And if we didn't answer your questions, because I remember that things were a little bit different in the 80s, and I understand what your point is. But I'll share it with David because we need to get some glasses out to read it, and then we'll answer back directly, Tim. Thank you very much for that. So thank you all for your time. I hope that you found this useful and helpful. It certainly helped me, so I'm hoping it helped you as well. And we will stand by and see what the Fed has to say to us next week. Take care, everyone. We'll chat with you soon.
Thank you.
Thank you.